Hello students, financial reporting. So we are covering some past paper questions from our BPP kit. So let's cover one question from BPP kit, that is Pirlo company. So let's see what's the requirement of the question. If you see the question, there is a profit and loss account data given, and there are so many additional information, 1 to 8 are given. And normally student by looking at so many adjustments got confused. So don't be confused, just relax. If there is more information, the question will be easier. If there is more information, the question will be easier. It will take some time, but the question will be easier. So there are 4 requirements of the question. Altogether 20 marks question. Requirement A for 4 marks, requirement B for 3 marks, requirement C for 3 marks, and requirement D for 10 good marks. 10 very good marks. Requirement A. Calculate the gain or loss on the disposal of Samba company. We need to calculate gain or loss on disposal of Samba company, could be subsidiary, which will be recorded in individual financial statements of Pirlo company and consolidated statement financial position of Pirlo company. We need to calculate gain or loss on subsidiary disposal that should be recorded in individual financial statements of parent company. And you need to calculate gain loss that should be recorded in consolidated statement of financial position for Pirlo Group. What is part B? What is part C? What is part D? We don't know yet. So let's move towards covering this requirement A first. Requirement A. So gain or loss for individual financial statements and consolidated financial statements. And we know the formula. So requirement A. So individual. And then we need to calculate for consolidation, and for individual, we know the formula. What is a formula? Sale proceed mean cash amount. From that, we need to deduct cost of investment. You will be able to calculate gain or loss on disposal. And for consolidation, we know the formula. What? From sale proceeds, we need to deduct the combination of fair value of net assets at disposal plus fair value of goodwill at disposal minus fair value of NCI at disposal. So what is the value of these 3 combination that we need to deduct from sale proceeds? So we'll be able to calculate what? Gain or loss on disposal. So we know the formula, just to put the figures. So let's read the question. The consolidated statement of profit or loss for the Pirlo Group for the year ended 31st December 20x9 and 20x8 are shown below. In previous year and current year figures are given. Year end is 31st December. Revenue for both years is given. Cost of sale for both years is given. Gross profit. If you see, revenue has decreased, cost of sale decreased, gross profit increase. Operating expenses increase, profit from operations decrease. Finance cost increase slightly, investment income slightly decrease, profit before tax decrease. Share of profit for associate is this one, and tax expense decrease, and profit for the year decrease. This is data given for profit and loss account, but we need to calculate disposal of Samba subsidiary. Okay. So attributable out of this profit, attributable to shareholder of Pirlo company mean parent company share is this one, while non-controlling interest share is this one. Mean they have prepared consolidated profit and loss account. The following information is relevant. On 31st December 2009, in at year end, the Pirlo Group disposed of its entire 80% holding in Samba company, a software development company, for 300 million. So 300 million we got what? Sale proceeds. So we are going to calculate figures in dollar thousand. So 300 million. So 300,000. So sale proceed is what? 300,000 dollars. Thousand. Okay, let's move. The Samba company results have been fully consolidated into consolidated financial statements above because they are disposing of on 31st December. Samba company does not represent a discontinued operation, and this is not a discontinued operation. Why? We'll see it. The proceeds from the disposal of Samba company have been credited to suspense account, and no gain loss have been recorded in financial statements above. Mean this adjustment is not made to the financial statements. Okay. Pirlo company originally acquired the shares of Samba company for 210 million. So this is what cost of investment to 10 million. So they bought for 210 million. So 90 million is the gain on disposal that should be recorded in individual financial statements. Is that? Now we need data for fair value of net asset at disposal, fair value of goodwill at disposal, and fair value of NCI at disposal. Let's see. Okay. At this date, goodwill was calculated 70 million. When they acquired. We need goodwill value now if there is any impairment in the previous year. Goodwill has not been impaired since acquisition, and external advisor estimated that the goodwill arising in Samba company has a value of 110 million at 31st December 20x9. So goodwill 70 million was at acquisition. There is no impairment. This means carrying value of goodwill at 31st December 20x9 is what? 70 million. And we do not need to record the up value. We need to record only the carrying value that is in the book after impairment. If there is no impairment, this is a fair value at the time of disposal. How much? 70 million. This figure is given. 70,000. Is that? So let's move forward. Okay, Samba company has a value of 31st December. On 31st December 2009, Samba company had net assets with a carrying amount of 260 million, in carrying value of fair value of net assets at disposal. That is what? 260 million. So we got this figure as well, 260 million. Is that okay? In addition to this, Samba company brand name was valued at 50 million at acquisition. And they were having a brand name at acquisition of 50 million in the consolidated financial statements. So this should also be added to what fair value of net assets. So this should be 260 plus 260 plus that 50. So this is what 310,000. Yeah. And goodwill is what? 70 million. Figures in thousand. Okay. At acquisition in the consolidated statement of financial position, this is not reflected in Sama company's individual financial statements, and the value is assessed to be the same at 31st December and same value is at disposal date. Okay. Sama company is only subsidiary in which the Pirlo group owned less than 100% of the equity. The Pirlo Group uses the fair value method to value the non-controlling interest at 31st December 2009, mean at disposal date. The non-controlling interest in Samba company is deemed to be 66 million. So fair value of non-controlling interest at disposal, that is also given 66 million. So please calculate the effect. 310 minus 70 is equal to what? 240 minus 66. 240 minus 66. That is 174. And if we deduct 174 from this sale proceed, we will arrive at what? Gain on disposal. That should be recorded in consolidated financial statements. And that is what? What is what? That is what? Gain or loss? Sorry. My calculation is wrong. 310 plus 70 minus 66. So that is 314,000. That is what? 314,000. So there is not a gain, there is loss on disposal of 14,000. Can you understand this? Loss on disposal of 14,000. So part A we have completed. And we have done with these 5 notes. Let's read note 6, 7, 8, and then we will move towards what is part B. Note 6. Until December 2028, in till last year end, Pirlo company rented space on its property to a third party. Okay. This arrangement ended and on 1st January 2009, Samba company's administrative department moved into Pirlo company's property. In the start of the year, Samba company was using Pirlo company apartment. Pirlo company charged Samba company a reduced rent. And Samba company's properties were sold in April 2009 at a profit of 2 million, which is included in administrative expenses. For the current year 2009, Samba company was using Pirlo company property on a nominal rent. Obviously, now they are selling Samba company, so that property will be vacant. And the Samba company sold some of its properties during the year and made a profit of 2 million. Okay. On 31st December 2009, at year end, the employment of the two founding directors of Samba company was transferred to Pirlo company. Mean after disposal of subsidiary, their directors are transferred to parent company, mean Pirlo. Okay. From the date of disposal, Pirlo company will go into direct competition with the Samba company. As part of this move, the directors did not take their annual bonus of 1 million each from Samba company. Instead, they have received a similar joining fee from Pirlo company, which was paid them on 1st December 2009. Mean their bonus was due in Samba company. Obviously, they were leaving Samba company, so that Pirlo company provided them as they were leaving Samba and joining Pirlo company. In fact, these individuals have excellent relationship with the largest customers of Samba company and are central to Pirlo company's future plans. Obviously, they will be able to attract the Samba company customers through these directors. That's why they have attracted them to Pirlo. Okay. Samba company's revenue remained consistent at 26 million in 20x9 and 20x8. And Samba company has a high level of debt. Key ratios from the Samba company financial statements are shown below. Gross profit margin of Samba company in 20x8 was 80 million, in 20x9, 81 million, very high. And operating profit margin 41 million, while in 20x9 moved to 66 million, even it's high. Interest cover was 1.1 million and 1.2 million. Why? Interest amount is more because they are basing on high level of debt. That's why their interest cover is just 1.1, 1.2, even increased. Okay, what we need to do? Requirement B. Calculate the ratios equivalent to those provided in Note 8 for the Pirlo group. For the years ended 31st December 20x9 and 20x8, no adjustment is required for the gain loss on disposal from A. Mean according to given data, whatever is in the question, we need to calculate these three ratios for Pirlo group as well. So we can calculate for Pirlo group as well. So requirement B of the question. Ratios for Pirlo. GP margin, profit margin, and interest cover are both here. So GP margin for 20x9 and 20x8. So here we can put a line so that we can differentiate both years. So to calculate GP margin, GP over sale into 100 for 20x9, GP is 97,860. So 97860 divided by sale, that is 213480. 213480 multiply by 100. So we calculate 20x9 figure, that is what? 45.8%. 45.8%. Is that okay? And for 20x8, you will see GP is 97310. 97310 divided by sale is what? 216820. 216820 multiply by 100. So that is what? 44.9%. 44.9%. Is that? Okay, so GP margin we have calculated. Now moving towards operating profit margin. Operating profit margin for 20x9, we are having how much? How much is operating profit? 255,500. So 255,500 divided by say 213,480 multiplied by 100. So that is what? 11.9%. And operating profit for 20x8 is 29170. So 29170 divided by 216820 multiplied by 100. So that is what? 13.5%. Okay. Next, we need to calculate interest cover. That is what is equal to operating profit divided by interest. So operating profit will be 255,500 divided by finance cost. If we see finance cost is 17,800 and 16,200. 17,800. So how many times? 1.43 times. And for this, finance cost is what? 16,200. So 29,670 divided by 16,200. Yes, 16,200. So that is what? 1.8 times. So if we see GP margin has been increased slightly, operating profit margin decreased, and interest cover increased. Okay, we have calculated this for requirement B. Requirement C for 3 marks. Requirement C for 3 marks. Briefly explain the conditions. Briefly explain the conditions that the directors of Pirlo would have considered in determining whether Samba company was a discontinued operation, and briefly explain the impact on the group financial statement if they had determined that Samba company was a discontinued operation. You need to explain what will be the accounting treatment if it is discontinued operation, and how they can identify whether it is a discontinued operation or not. So discontinued operation mean your business that you are going to sell, if it is of separate line of business, separate line of business mean performing a different type of operation than rest of the business, are operating in a separate geographical area. Separate geographical area means they are operating in that area whose laws, regulation, risk, reward are different from rest of the business. So then it will be called separate segment. Mean this is criteria for separate segment. And if your any of the business operation meeting this separate segment criteria and you are going to discontinue it, so that will be called discontinued operation. And if you are discontinuing a significant part of operation, you need to provide a separate disclosure in the current financial statement, as well as you need to disclose its income, expenses, and profits separately in the financial statement. So these things we need to write down for 3 marks here. And requirement D of the question for 10 good marks, comment on the performance and interest cover. Performance means GP margin and profit margin of Pirlo Group for the year ended 31st December 20x9, 20x8 mean you need to comment on the ratios. And your answer should comment on the overall performance of the Pirlo Group. How once accounted for the disposal of Samba company will impact on your analysis. Mean after Samba disposal, whether the results has been improved or declined. And the implication of the disposal of Samba company for the future results of Pirlo company and whether company will survive in better way after Samba or in poor way after Samba. Overall, if we see regarding profitability comment, if we talk about the GP margin, so part D, if we talk about the GP margin, so that has been improved overall from 44.9 million to 45.8 million. Despite company sales has been declined, GP margin has improved slightly. This means this is due to better control of cost. That's why GP margin has improved despite this percent decrease in sale. This means company is better managing its supplies from the supplier. Might be they have negotiated some discount from the suppliers. And if we see GP margin of Samba, GP margin of Samba were 80%. GP margin of Samba were 80%. This means Samba GP margin was high, 81%. And without Samba, if we see company is having a lower GP margin, this means Samba was having high GP margin. Mean this GP margin was maintained due to Samba, and by exclusion of Samba, company results will be poor. Even we can discuss about sale as well. Like if we see the sale has been declined from 20x8 to 20x9, and Samba sales remain same. They said 26 million each year. This means the decline in sale is due to other subsidiaries in the group, not due to Samba. Because the Samba sale was maintained 26 million, this means the decline in sale is due to other subsidiaries in the group. This means there might be some subsidiaries who was loss making, who are reducing their sale. So we can discuss sale. And then we can discuss GP margin, and GP margin has increased, better cost control, but the Samba GP was 81%. So they were generating a high GP margin. And this company improvement in GP margin is might be due to Samba only, not due to other subsidiaries. So in the future, this GP margin might be reduced because Samba will not be there. Because Samba was performing better. They were having much better cost control as they were having more than 80% GP margin. And then we will discuss about operating profit margin. And if we see profit margin overall for the company has reduced from 13.5% to 11.9%. This means company is struggling to manage its operating cost. And if we see profit and loss account, where is the main operating expenses have increased despite decrease in sale, operating expenses has increased. Finance cost slightly increased. Might be the finance cost increase is due to what? Due to Samba is having a highly dependent upon debt, but operating expenses has increased. So this means companies are struggling to manage its operating cost. If we look at Samba operating profit margin, that was 41% to 66%. This means Samba operating profit margin has increased by 15%. So Samba operating profit increased by 15%, while overall Pirlo Group operating profit margin has decreased. This means this decrease in operating profit margin is due to other subsidiaries in the group that are remaining. That is a serious concern for the company. And after departure of Samba, company might will struggle to generate profitability to manage its operating cost control. We can discuss this. Is that what else? Might be Samba profit margin increase because they sold some asset during the year. By how much they sold asset during the year? They sold some asset. Samba sold some asset during the year. There was some information. There was some information. Samba sold some asset during the year. Yeah, for 2 million. Might be Samba operating profit margin increase of to 66% is due to that 2 million profit on disposal. So this could be the reason. And then we will discuss about interest cover. If we see the overall performance of the company, interest cover has reduced from 1.8 to 1.43. One point eight to 1.43. What's the reason for reduction in uh, interest cover? Either profit decreased or finance cost increase, and it seems profit decrease as well as also finance cost increased. While Samba was having 1.1, 1.2 interest cover, mean reduced. And this reduction is might be due to Samba because Samba was highly dependent upon debt. And after departure of Samba, might be that debt will also move towards the Samba, and for the remaining group, there will be low debt, there will be low interest expense. So this will improve after departure of Samba because Samba debt might be affecting this interest cover because high debt mean high finance cost. So after departure of disposal of Samba, that debt will be removed from the group. Not only that, finance cost will be reduced, and this reduction in finance cost will improve interest cover for the business. So conclusion, if we see overall, the Samba performance was better in terms of sales smooth, in terms of GP margin very high, even in terms of improvability in profit margin. And if company operating profit margin has reduced, this means this is due to other subsidiaries in the group, might be some of our loss making. So Samba disposal is not beneficial for the group because it was generating good profit. So might be company will struggle after the Samba disposal, but might be Samba performance was due to two directors. That was the founder of Samba, and they are having some contract with the customers. If they are moving to Pirlo Group, might be they will able to attract the customer that was behind the success of Samba. So if they will be able to successfully attract the customers, and performance of Samba was dependent upon two directors, and they will perform in the same manner as per previous in future in Pirlo Group, then might be company will survive better way despite departure of Samba. So these things we need to write down here. 10 marks. So examiner want in-depth analysis. Try to read the answer of this part, especially D, before moving to the exam. So that's it.